Hello, everyone, and welcome to today's NOVA presentation, Catching Up on Catch-Up Contributions with Craig Hoffman and Kim Rader. Before we get started, I have a few housekeeping items. At the top, I'd like to point out the question mark. This is where you can ask any questions you may have for Scott or for Craig and Kim. Note, we do not have a lot of time, so we'll try our best to have a Q&A portion at the end, but if time runs out and you still have questions, just email them to us and we will try our best to get those questions answered. Right next to the question, you will see a paper icon. This is our handout dropdown, in which you can find today's material in PDF form. If you're unable to view it or click on it, go ahead and email us and I'll make sure to send you a copy. If you are here for continued education credits, please be sure to stay until the end to fill out the pop-up survey. This will allow us to track your time participation. Certificates will be sent out within a week for those who have met the time requirement. To view any past webinars you may have missed or a recording of this session, you can follow us on our YouTube channel. Nova 401k Associates. Thank you for joining us, and I'd now like to introduce you to Senior Consultant and Attorney Craig Hoffman.
Thank you, Ava. Good afternoon to those of you on the East Coast. Good morning to those on the West, and hello to everybody in between. Thank you for joining us on our Catching Up on Catch-Up Contributions. A little housekeeping of my own. This is general discussion of legal issues, not meant as personal or legal advice. Find your own lawyer and talk to him or her if you need your personal legal advice. We are a CPA approved provider. I know in Texas, but as Ava said, if you follow the procedures, we will send you a certificate irrespective of the CPA credit provisions. That's me. I've been doing this stuff for about over 40 years, actually. But I'm very happy coming up now on 5 years that my friends at Nova gave me a home to keep me busy here as I kind of try not to work too hard. But Nova's a great place, great company. I've been friends with the Nova family for many years before I came to work with them. And so I'm happy to be part of the Nova team, and we're happy to have you joining us today. But that's me. And I can't help but begin with my good friend and colleague, Fergie. She's now 3.5 out at the dog park. We're heading there after today's webinar, as a matter of fact. But she plays very hard and occasionally has to rest. And she always makes sure to keep her toys close to her. No, don't want to. And notice she's got several more scattered around behind her, but got to keep them close. Anyhow, we go on to the more mundane but important stuff, the catch-up contributions. This is what we're going to talk about. We're going to begin with some background just to set the stage. Then we're going to focus on what Secure 2.0 has done with both super catch-up contributions, which are already effective, and the Roth catch-up contribution requirements for certain higher paid participants, which will be taking effect next year. There's a lot to talk about, a lot to get ready for before 26. So let's proceed ahead. So again, just to set the stage, catch-up contributions have been around for over 20 years. Congress gave them an extra. The idea was to allow those getting closest to retirement to goose up a little bit bigger contributions so they can catch up with their retirement savings before they get to their actual retirement age. But there is a legal definition, if you will. Catch-up contributions are elective deferral contributions made by a catch-up eligible person, i.e., they're at least age 50 in the current tax year, that are made in an applicable plan. And we're going to focus on 401k and 403b plans, but there are other plans can provide for catch-up contributions. So it's elective deferral by a catch-up eligible person in an applicable plan that exceeds a limit. And there are really 4 limits. The first limit is the statutory limit, which there are 2 statutory components to that, the 402G and the 415, the ADP limit or the plan limit. Let's talk about those limits individually. The normal limit on elective deferrals. This is what we most commonly think of when we think of a catch-up contribution, is one that exceeds the normal limit that's set forth in Code Section 402G. So for better or worse, it's gotten that moniker, the 402G limit. The current normal 402G limit is $23,500. And that limit is an aggregate limit on how much a person can contribute to all plans he or she may be in. So if you work a day job and then at night work for a different company and you're in both of their plans, the most you can put away between all of those plans is $23,500. But it's also an individual plan limit. Each plan must apply that to the participants so that no participant in a plan can exceed the normal 402G limit unless they're catch-up eligible. That's where we're leading to here. So it's an individual plan limit, and in that circumstance too, if a person participates in two plans, but both plans are sponsored by the same related employer group, then the plans of that related employer limit must take into account the aggregate amount between all plans. But generally, we think of this as a plan limit that the plan must impose, and the most a person can put away is $23,500 unless they're catch-up eligible. The 415 limit comes up less often in the context of catch-up contributions, but it's a maximum statutory limit on the amount of allocations a person can receive in a defined contribution plan like a 401k or a 403b for that matter. The limit for this year is 100% of comp, or if less, $70,000. It too is an individual limit that the plan must apply as a qualification requirement. But catch-up contributions can permit you to exceed that limit because they're not taken into account for purposes of the 415 limit. So, for example, Jane puts away $7,000 in elective deferrals during the year, and lo and behold, her company had a great banner year, and she ends up getting a $70,000 profit sharing contribution she wasn't anticipating. That gives her annual allocations of $77,025. That's in excess of the limit, but we can recharacterize those 7,000 of deferrals as catch-up contributions and thereby leave them in the plan. And so that's another way, another limit and a manner in which an elective deferral can be categorized as a catch-up contribution. The ADP limit is unique to 401k plans, not 403b, and even there, it's non-safe harbor 401k plans. So many of our plans today are safe harbor plans and don't have an ADP test. But if it's a non-safe harbor plan, then we have to compare the average deferral rate of the highly compensated group to the non-highly compensated group. If the highly compensated is too high, certain of the highly compensated have to get corrective distributions to lower the average rate for the highlies. But if the 401k regs mandate, and this isn't even an option, the 401k regs say if you're going to make a corrective distribution because of a failed ADP test to a highly compensated employee who has room to make catch-up contributions, then the plan can't distribute them, must recharacterize them as catch-up contributions, and that occurs after the year is over, which kind of muddles the waters as we try and deal with this Roth issue. But it does happen, and so it is another avenue potentially where you can have a catch-up contribution for exceeding the ADP limit. And then finally, you can have a plan limit. A plan limit is one adopted by the plan sponsor that is incorporated into the plan's terms. The idea, you can see this if you've ever worked with a pre-approved plan that has an adoption agreement where you check what selection, how the plan's designed. There's typically in a 401k adoption agreement a section where you can limit deferrals to, say, percentage of compensation or even a flat dollar amount. Now, plans with these kind of limits were popular 20 years ago because, believe it or not, I know many of you were not around at that time, but there was a time. If you failed the 401 ADP test, the only way to correct it was by making a QNEC type contribution. Well, that went away 20 years ago, over 20 years ago. We can make corrective distributions if need be. We also have a lot more safe harbor plans, so we don't really care that much about imposing a limit that is intended to keep us from failing the test. So plan limits are still out there in some plans, but we see fewer plans with them. So bottom line, clearly the most common reason and the most common application of catch-up contributions is in the context of exceeding the normal 402G limit, which this year is $23,500. So that's the background. Now we can move forward to what's new in the on the scene for catch-up contributions as a result of Secure 2.0, which was enacted in late 2022, and it had two distinct sections that are important to us in dealing with catch-up contributions. First, Congress decided that certain folks who are closer to retirement age than merely attaining age 50, these older people, and I'm older than all of them, so I don't seem that old to me. But anyhow, certain individuals will now get a catch-up contribution limit that's 150% of the normal limit. And this change is effective for tax years beginning this year. That began in January 1st of 2025. Now, plans are not required to incorporate these higher limits, but if a plan wishes to do so, participants can do so beginning this year. And even if they have not taken it or recognized this potential extra contribution availability, there's still 5 months left in the year that they can increase their contribution rate to make up the difference if they want to do it for this year. But this is only available to a select group of old people. Only those who are age 60, 61, 62, or 63 during the year are eligible to make super catch-up contributions. So for this year, 2025, the eligible class, if you will, are those born in 1965, 66, 67, 68. Next year to be those born in 66, 67, 68, and 69. You see the progression. And originally, this was going to be available to anybody over 60, but it would have cost too much in foregone tax revenue by too many people taking advantage of it. So this compromise was ironed out with the biggest proponent of this provision in Secure 2.0, a congressman from a district south of Atlanta that just happened to have he had a significant number of constituents who were airline pilots who worked out of Atlanta's Hartsfield Airport. And they have to retire at age 65 mandatorily. So this compromise was okay with that congressman, and it still allowed those pilots to at least get some extra catch up. So it's still available. It's 150% of the normal limit. So for 2025, the normal limit is 23.5, whether you're super catch-up eligible or not. For regular catch-up, it's 7,500. Super catch-up, it's 11,250, and you can read the numbers. Now, these catch-up limits will increase in 2026 for cost of living, but there's kind of I'm not sure if it was a glitch, but the way I read Secure 2.0, the super catch-up limit doesn't increase in 26. It doesn't start COLA adjusting into 27. So we will not have the actual 26 numbers until likely October. That's when the IRS normally announces them. But based on early projections, we're looking at $1,000 increase likely in the normal limit and a $500 increase in the normal catch-up limit, with the super catch-up staying at 11,250. So catch-up contributions are good. I mean, who can complain with the ability to put away a little bit more? The problem is Congress stuck their finger into this and have given us chaos for 2026. And what's really upsetting to me is this change in the law was done for no other reason than to raise revenue by to pay for other tax laws changes in the pension area. So the good things we got in Secure 2.0 that reduce taxable income are being paid for by this Roth requirement that increases taxable income, at least in the short term, over the next 10 years. And so there's no real reason for it other than raising revenue, and then it's put in our hands to deal with it. So under Secure 2.0, catch-up contributions made by certain highly paid participants must be made, if at all, as after-tax designated Roth contributions. Now, I'm using the term highly paid participants, but that is not at this point, there's no commonly accepted term of art to describe these people who must make catch-up as Roth contributions. I've seen them described as highly paid individuals, highly compensated individuals. For better or worse, I'm calling them HPPs. And so that's what we will use to refer to this class of people that have no choice. If they're going to make catch up, they've got to make them as Roth. And we'll come in a moment and explain who they are. Now, this was effective for 2024 and years thereafter, but it was recognized by many that Congress did not give the providers enough time to prepare for this. The payroll providers and record keepers complained mightily, lobbied heavily for an extension, and were successful. In 2023, the IRS issued Notice 62 that established what they call an administrative transition period for tax years 24 and 25, under which these HPPs can still make pre-tax contributions without disqualifying the plan, pre-tax catch-up contributions without disqualifying the plan. It was interesting. This is a concept that I've never seen in my 40 years of doing tax law, where the IRS ignores the law and says we've got an administrative transition period, but nobody's complaining. We needed it. And in fact, people are already screaming we need another extension, but I'll come back to that in a moment. So this takes effect in 2026. That's 5 months from now. And we got a lot of work to do to be ready in 5 months, I'm afraid. So one of the reasons we were requesting, why folks were requesting extension was lack of guidance. And so the IRS, to their credit, got guidance out in the form of proposed regulations January of this year. And that's great. Proposed regulations are out. We can rely on those proposed regulations until final regs are issued. The problem is the rumor mill in Washington is saying that final regs could be released literally at any moment. I was on an American Retirement Association, the NAPA, the Plan Advisor Group with an ARA government affairs call this morning. And Kelsey Mayo, who's, I believe, Director of Regulatory Affairs, a position I once held at ARA. Anyhow, she affirmed that that is still the strong rumor and that these final regs are probably just being held up in clearance by the uppity-ups higher up in IRS who've got too many things on their plate, I guess. But the point being, the final regs are going to be out soon. At least that's the best word on the street. And so the good news is the proposed regs tell us those final regs will not be effective any earlier than the first tax year beginning 6 months after they're published. Well, it's July, it's soon to be August, and that means if they're published tomorrow, the first tax year beginning 6 months later is going to be 2027. So for 2026, we can follow the proposed regs and rely on them, and that's fine. But there's always a but. There may actually be some better, more flexibility positions that are changed from the proposed regs to the final regs that we may well want to take advantage of come January 1, 2026. So, and you'll be able to do that if you want to, but it's going to lead to a bit of a hectic time over the next few months as we all try very hard to put this in effect beginning 1/1/26. So let's go to the meat of the coconut, as they say down here in Florida, which is actually where I do reside. The good friend people at Nova have given me the opportunity to work remotely. So here in Florida, when we get to the meat of the coconut, we look at the brass tacks. To throw in another cliche, I got a million of them. So the first step: who are the HPPs? Who are these people that we need to identify so that any catch-up contributions are allocated as designated Roth, not pre-tax? Well, the statute is pretty straightforward. An HPP, this group, is a catch-up eligible participant who had wages from the employer sponsoring the plan that exceeded $145,000 in the previous tax year. And that $145,000 threshold will be adjusted in the future for cost of living. But as we look to 26, we're looking to who made more than $145,000 in tax year 2025. So this, what could go wrong? This is a pretty straightforward definition, seemingly, but unfortunately, with the IRS, the devil is always in the details. So let's begin with devilish detail one. That 145,000 threshold is based on wages, but the proposed regs tell us the wages you use have to be the wages, the definition used for applying the Social Security portion of the FICA taxes to wages. Now, that definition is easily ascertainable. It corresponds to box 3 on a person's W-2 form, but it is not a definition that has been previously incorporated into the pension laws, administration, and compliance. It's not a safe harbor definition for discrimination testing under Code Section 414F. So it's a definition that's out there, but the fact is pension record keepers and payroll providers typically haven't been sharing it because there's been no reason to. So that's going to be a challenge in implementing this, is getting the data necessary to determine who are these HPPs based on their FICA Social Security wages. Now, one good thing is this threshold 145 does not need to be prorated in the employee's initial year of employment. It is what it is, and we'll illustrate this in an example in just a few minutes. So that's the first bugaboo. It's HPP wages. And almost forgot, because it's FICA Social Security wages, not all folks participating in a 401k plan or 403b get FICA wages. Now, on the 401k side, in particular, you have plans sponsored by partnerships and sole proprietorships. And the owners of those partnerships, or the owner or the sole proprietor, do not receive FICA wages. They receive self-employment income, which is not subject to FICA taxes. It's subject to a similar tax, self-employment tax, but it's not FICA wages. And the proposed regs confirm that partners that receive only self-employment income, and that's it, don't receive any FICA wages, are not HPPs and not subject to the Roth mandate. which, needless to say, adds some complexity to our testing. Similarly, particularly in the 403B arena, you may have some governmental employers who have elected out of the Social Security system so that these governmental employees, their wages are not subject to FICA taxes. And so they may not be HPPs. But keep in mind, this is different for Subchapter S companies. We tend to think of Subchapter S as pass-through entities, and they are. But in order to get a pension benefit in a Subchapter S sponsored plan, you've got to be an employee receiving wages, W-2 compensation. The pass-through income is not compensation for purposes of a plan, the pass-through to a Subchapter S owner. So the only thing we're really talking about, at least back to the context of who's catch-up mandated because of the FICA wages, it's not going to be partners or sole proprietors, and wouldn't be state or local government employees if their governmental employer is elected out of the Social Security system. Excuse me. And so that's complication one. Complication two is its wages from the employer sponsoring the plan. That was the second element. Well, there's no definition for that in the statute, but the IRS, ever helpful, has given us an interpretation that frankly has caught many of us by surprise. Under the proposed regs, the employer sponsoring the plan means the common law employer for whom the participant performs services as an employee under the common law test that apply across the board, but also apply for purposes of FICA taxes. Excuse me. Bit of a frog in my throat there. So what does this mean then in practice? Well, that means if you've got an employee who provides common law services for multiple members of the same controlled or affiliated service group, that employee's wages and participation, as far as having to have Roth or not, is determined independent of each other. So that if you have, for example, a doctor, a dermatologist, he's got a dermatology practice, but he also owns a pathological lab, and he works for both. And they're a part of, let's just make it easy, he owns 100% of both. They're a control group. Well, his wages from each are independently determined whether the deferrals he makes out of those wages to the dermatology plan versus the pathology lab, he may be making have to make Roth with regard to the dermatology plan because he makes $400,000 there, but he only gets $50,000 from the pathology lab. He could make pre-tax there, and I'll illustrate this in a case study example in a moment, but that is going to present some potential challenges in collecting the data and implementing it. And this is true even if both employers are in the same single plan. It's not obviously not uncommon to have multiple members of a commonly controlled group of corporations or other entities to have a single plan that each employer is a participating employer. Well, that's great. But for purposes of this Roth mandate, you have to look at them independently with regard to where the employee performs services to determine how that affects his or her, the applicability of the Roth mandate. Now, many comment letters filed by folks interested in the proposed regs took issue with the definition and really said it wasn't called for by the statute and will be a pain in the neck, amongst other places, to administer. So we're crossing our fingers and hoping there may be more flexibility, that you are not forced to do this. You can do this if you want, but you can if you want to aggregate control groups. But I'm not telling you can do that. I'm not even sure the IRS is going to back off on that, but that is something folks are asking for. And these same rules carry over if it's a MEP PEP. If you're a participating employer in the MEP, you're not aggregated with any of the other MEP participating employers where the employee may work. Excuse me. So it's really no different whether you're in a MEP or a PEP or in a single employer plan with other members of your controlled group. It's also true for multi-employer plans where an employee may work for multiple employers who are in the plan because they're all subject have adopted and are participants in the same collective bargaining agreement. So that's complication number 2, employers sponsoring the plan. So let's take a look at a case study. We've got Mr. Wiley E. Coyote, age 76, who works for Acme Anvils full-time, January 1st, 25. He's still working there, 23 months later in November of 26. And during that 23-month period, he was making $20,000 a month. He's a very valued senior advisor to Acme Anvils. And I guess everybody still watches the Wile E. Coyote and the Roadrunner cartoon. So I know I'm dating myself. I actually checked, and the first Coyote Roadrunner cartoon was back in 1949. So Wiley actually is 76, and God bless him, still working hard for Acme. So let's get to the facts here. So on December 1 of 26, Wiley goes to work for Dynamite Design by Acme, a separate company, but part of the same Acme control group. And he immediately is paid a salary of $20,000 a month by DD, the Dynamite Company. So in 2026, and we're going to look at 27 first. We'll come back to 26. But we look at for 27 and whether Wiley is subject to the mandate of Roth for catch-up or not is based on his 2026 wages. So in 2026, he made $220,000 from Acme Anvil and only $20,000 from Dynamite Design. So in 27, we ask, is Wiley subject to the Roth catch-up contribution in the Dynamite Design plan? He's now working for them full-time. He started in December of 26, 27. He's there the whole year. Is he subject to the Roth mandate? The answer is no. The reason being the Dynamite Design is a separate common law employer of Wiley. Dynamite Design, he only made $20,000 in 26. That's not more than $145,000. And we don't have to prorate for that first year. So we take him as he is, $20,000. He is not that any deferrals that are catch up that he makes into the Dynamite Design out of his wages from Dynamite Design into the plan sponsored by Dynamite are not subject to the Roth in 27 for Wiley E. And it doesn't matter if they're participating employers in the same plan that's jointly sponsored by all the Acme Control Group. And it doesn't matter if they're using the same common paymaster within the control group to issue paychecks. And I didn't address that earlier, but there is a procedure whereby commonly controlled entities, control group corporations can appoint one of their own as the common paymaster for all their employees. And you see it frequently. I'm not sure how frequently, but it's out there. And there's nothing wrong with it. And large corporate groups do it for efficiencies and payroll. But the proposed regs say that's great for payroll purposes, but for purposes of this mandate, common paymaster doesn't change anything. You need to separate out Wiley's wages separately from Acme and Acme Anvils and Dynamite Design. So let's step back, though. What happened in 26? So now we're looking at what Wiley made in 2025. Well, in 2025, he worked the entire year for Acme Anvils, made $240,000 in wages. In 26, he went to work for Dynamite Design, and let's assume he immediately got into the Dynamite Design plan. And so he had wages eligible for deferral into the Dynamite Design plan in 26. So what does this mean? What is Wiley's what's the application of the Roth mandate in 26 to Riley? Well, as far as the Anvil plan, he is subject to the Roth catch up because he worked all of 25 for Anvil and he received the more than $145,000 in wages. That's easy. But what about the 20,000 in wages that he had available for deferrals into the Dynamite Design plan for that last month of 26? And there he is not subject to the mandate because in 25 he got no wages from Dynamite Design. He's not above the 145 threshold. And so for that last month, his catch-up contributions can be made as pre-tax contribution. He's not subject to the mandate, and there's no proration. Actually, there was no compensation at all. The proration was in the last question. And nothing changes even if it's a participating employer, even if they're participating employers in the same plan. So that's going to be a challenge. Let's talk about some potential ways to get around that. Let's begin with credit for early Roth. If a person is eligible to make Roth, irrespective of whether their contributions are going to be characterized as catch up or not. And so the regs provide if a person chooses to make Roth contributions early on in the year, then if it turns out some catch up contributions, which were allocated as pre tax, are subject to the mandate, the plan can take credit for the early Roth, and to the extent it has satisfied the amount that would otherwise be catch up, no further. You don't have to reclass the pre-tax amounts can stay in the pre-tax account. So this is nice. I'm not sure how often we'll be able to use it. I mean, one way you could use it is to have in a plan where you know you've got HPPs and they're going to be subject to Roth. Get it out of the way and make it early in the plan year. What I found in most cases, people are making Roth, at the beginning of the year. They're doing it because they want Roth for the entire year. So I come back to not sure how helpful this really will be. The deemed Roth election, however, is important because generally a participant must make an affirmative, irrevocable election at the time of the deferral to designate the contribution as being Roth rather than pre-tax. Well, you may have circumstances where an employee has made a pre-tax election, and lo and behold, it turns out some deferrals going in that were elected to be pre-tax are going to be catch up and have to be designated as Roth. And the regs allow the plan to include a deemed Roth election under which the employee is deemed to have designated them as Roth. And this would be important when we're dealing with circumstance where deferral is recharacterized after the year is over as a catch-up, such as with the ADP test, or with spillover designs where you've got pre-tax going into the pre-tax bucket and it spills over into the Roth catch-up. And rather than having to get a new election from the person, you can deem it to have been now Roth. It's also a condition precedent to certain corrective options. You must, at least under the proposed regs, must have this deemed Roth election. So most plans will want to include it. There is one bit of a concern, and that is the proposed regs say to use the deemed election, the participant subject to the deemed election must be given, quote, an effective opportunity to make a different election. And the proposed regs cite to the 401k reg, which I've cited for you, which is a facts and circumstances test. It's all facts and circumstances, but includes the adequacy of notice, the availability of the election, the period of time you have to make the election, and quote any other conditions. And that's all great, all well and good, but it really doesn't help us. I mean, I think at a bare minimum, participants need to be notified that they are going to be subject to this Dean Roth election. The question is, notice in the SPD enough? It's probably better to give an annual notice, but we don't know what's required, and there's hope the proposed regs, or excuse me, the final regs when issued will clarify this. And keep in mind, for a person subject to the Roth mandate for catch-up, the opportunity to make a different election, the only election available is to not make catch-up contributions. So that's what the person can choose, either have them go as Roth or not at all, and you've got to give them or her an effective opportunity uh, to to uh, to make that call to not have them catch up rather than go in as Roth. Another plan design idea: can we prohibit Roth? Excuse me. Can we mandate Roth as the only way to make catch-up contributions? So every catch-up, whoever you are, goes in as Roth. And some have suggested this is a way to avoid all the complexity of determining who are HPPs. All I can say is nice try. The IRS says no, it's prohibited to have a Roth only catch up because, in the words of the IRS, it's inconsistent with the language in the Internal Revenue Code that says in order to make a Roth, you must have first an election of pre-tax, that you have pre-tax and must then elect Roth. You can't have Roth only. Nice try, can't do it. Well, what about the converse? Can you say we won't have any Roth, and so you HPPs can't make catch-up contributions? Well, let's begin by saying 90. There was a recent article where Fidelity was quoted as saying 94.4% of their plans have Roth. I think that's about the same as we have. So there's only about 5% of the plans that don't have Roth. And to be honest, I would heartily recommend biting the bullet and adding it. Can you go without Roth? The answer is in the regs, yes, you can do that, but be careful. You may have a discrimination problem, and that's because the definition of a highly paid participant is different than the definition of a highly compensated employee, who are the employees in whose favor you cannot discriminate in the availability of benefits or in the availability of plan benefit rights and features. And the ability to make catch-up contribution is a plan feature that is subject to non-discrimination testing. So to be an HCE, we can't discriminate in favor, or you can be a 5% owner or receive 415 comp in excess of a stated amount. Looking back a year, 2024, it was 160, so that's who we're looking at this year. And if plans wish to, they can limit that comp category to the top 20% ranked by compensation. An HPP is one who just made more than 145,000. So this can be problematic in discrimination testing. Let's take an extended example, but one that illustrates the point, i.e., we've got a law firm that operates as a partnership. There are two owners, each 55, each makes $500,000 in self-employment income. The law firm also employs two 52-year-old non-owner associate attorneys who are paid well. They each receive $150,000, but that's FICO wages, whereas the attorney owners are getting self-employment income. So the 55-year-old attorney owners are eligible to make catch-up contributions if the plan only allows pre-tax, whereas the two associate attorneys are not eligible to make catch-up contributions if the plan only allows pre-tax because they're HPPs. The net result is 100% of the Hileys have it available, none of the non-Hileys. And so the plan's disqualified in such a circumstance. So it depends on the demographics. You can avoid the demographic issues by saying not only will we not have Roth, so HPPs can't make catch up, but if you also said Hileys can't make catch up, even if they're not HPPs, that would solve the problem. But I'm not sure it's worth the efforts. I mean, certainly some HCEs may not be happy about that. So I think at the end of the day, we at Nova are strongly recommending bite the bullet for that small percentage of plans that hasn't added Roth. It's okay. Life will be okay even with Roth in your plan. Now, there may be mistakes. This could occur as a result of a compliance failure. It could result as a result of the ADP test, which happens. There's no compliance failure. It just was the normal operations of the plan. If a catch-up contribution that should have been Roth is allocated to a pre-tax account, it's got to be moved to a Roth account. You can't let it stay there. The IRS in the preamble warns that's a disqualifying defect, and the plan is subject to being disqualified if it's caught, whether on audit or otherwise. So you've got to take corrective action. The proposed regs give a couple of new ways to do it, but they come with a list of requirements and are time limited. In addition, the proposed regs say whichever of these new correction methods you use, you have to use the same method to correct a mistake made for people who had the mistake was made with regard to the same applicable limit. So it's saying, in effect, for all those people whose elective deferrals were catch up because of they exceeded the 402G limit. If there was a mistake in allocating them the pre-tax by more than one participant for the 402G limit, it's got to be fixed the same way for all of them in that category, which is silly. Not sure what the IRS is seeking to accomplish by this rule. It greatly limits potential use of some of these corrections, and we are very hopeful that we'll get more flexibility in the final regs. But until it's there, it ain't there. In most cases, the corrective option is subject to a requirement that the plan sponsor must have practices and procedures in place that are designed to result in compliance with the Roth catch-up requirement. In fact, and part of those procedures, as mandated by the proposed regs, is that it includes the deemed Roth election as part of the plan language. So the deemed Roth election is useful, but it's a condition prerequisite to being able to make certain of these corrections, which is yet again another reason underlying why you should have that, the deemed election. Now, it's not quite clear what the heck the IRS means by practices and procedures designed to result in compliance specifically with the Roth catch-up. I mean, we have Epker's rules for self-correction that the plan must have practices designed to promote and facilitate overall compliance, but it doesn't zero in on this specific Roth catch-up compliance obligation. And so we're not sure if this is just in addition to those Epker's procedures, something more robust. We've asked, commentators have asked for more clarity in the final regs. So that leads to the two new correction methods. The new correction methods that are most desirable is the W-2 correction method. Under this option, the plan simply transfers the elective deferrals adjusted for gain or loss from the pre-tax account to the Roth account. And the idea is, oh, we made this mistake. Let's move this to the pre-tax account, and then let's move it from the pre-tax to the Roth account. You then report it on the person's W-2 as income, as if it was made as a Roth all along. So again, I'm sorry I got distracted by a note coming up. So the idea is, gosh, we made a mistake. It's November. This guy's over the 402G limit. We put it in the pre-tax. It's a catch-up contribution. We move it from the pre-tax account to Roth. And then when we do the W-2 for the year, we show it as having been contributed as a pre-tax contribution, which is simple, great, best one out there. The problem is the form has not, in many cases, you're affecting the correction after the form has been filed for the year. And so for many plans, it sounds great, but it might not be available because you don't realize you've got a mistake until later in the year, or even worse, there could be problems because you've got to use a different method than you would have used earlier in the year, and you may want to just hold off using the W-2 method at all. So the most often used method is going to be the in-plan rollover correction method. This plan, it works much the same. You do a transfer of the amount that should have been Roth from the pre-tax to the Roth account, adjusted for gain or loss, but now instead of adjusting a W-2, you issue a 1099-R. And this is the same approach you would use. A 1099-R for reporting an in-plan Roth rollover conversion done irrespective of a catch-up contribution correction. And so it's taxable in the year of the transfer, but there are strict deadlines for accomplishing this correction. And they vary based upon, again, the reason for the limit being exceeded. If it is the 415 limit, then you have until the until 30 days after the deadline to make a deductible contribution in the case of a regular for-profit corporation, or 9.5 months after the end of the tax year for a nonprofit. And those aren't arbitrary deadlines. Those correspond to the deadline for making a contribution that is treated as allocable and part of your 415 limit in the prior year. For the 402G limit, it's April 15th, which obviously is the deadline for filing a tax return and thereby reporting it. For the ADP limit or a plan limit, it's 2.5 months into the plan year, unless you've got an automatic contribution arrangement that satisfies the rules to be an eligible automatic contribution arrangement and an EACA, in which case it's 6 months after the end of the plan year. And all of that, needless to say, is a great deal of complexity that serves no real purpose. So once again, there have been recommendations to make it simpler. How about just giving us a deadline to the end of the next year? Is that so hard, IRS? We're hoping for that. One last point, and I'll just hit this quickly. When you do an in-plan Roth rollover conversion, normally you're taxed on the rollover amount, but you don't get hit with the 10% early distribution tax under 72T. But if you take a distribution within 5 years after that in-plan rollover, you recapture, get hit with that 10% early distribution tax. The question is, does that same rule apply for these in-plan Roth rollovers as a corrective action for fixing the catch-up contribution that should have been Roth? And then the answer is we don't know for sure, but I think the best answer right now is yes. You will have independent 5-year clocks. And lastly, does the plan have to have in-plan rollover generally in order to use this corrective option? And the answer is we're not sure. I think you probably should have it for purposes of potential discrimination problems, because if the only people eligible to do an in-plan Roth rollover are those through a corrective on a Roth transfer, they may be highly compensated, and once again, we're running against discrimination problems. If you don't fit within those time frames, basically you're stuck with the EPCRs. And the IRS, talks about it matter of factly. This is how you correct without bringing up all the other prerequisites to use EPGARS. So it's not entirely clear if you do have to satisfy those prerequisites for self-correction. But under the changes made by Secure 2.0, it's pretty wide open on self-correction. So I've cited to you where you would look for the corrective options. So quickly, we've got 5 months left. That's what's next. Many questions for payroll providers and record keepers, whether they'll be ready by January 1. It's important to talk to your service providers. There is a chance there may be a further extension, but I wouldn't count on it. So buckle down and get ready for a bumpy ride. And we have some help, and my good friend and colleague Kim Rader is going to take control and give you some thoughts there. So Kim, we're going to change to a different PowerPoint. Take it away.
Thanks, Craig. So I will share my screen now and take it away. So in our last few minutes, my name's Kim. I am one of the directors of client relations here at Nova, and we'll kind of go through some tips and what is expected next for Nova clients. Of course, if you're not a Nova client, this may not all apply to you, but wanted to go over a few of the things today. So starting with super catch-ups, there is still time. So because super catch-ups were so new this year, it's likely that they're being underutilized right now, just because of maybe employees not used to it, but there still is time for 2025. So first thing first, if to go ahead and implement this for 2025, you need to check with your payroll provider first. As you may or may not know, all payroll providers are different, so it may be that your payroll provider, in order to add this, could be a phone call, could be a form you have to turn in, or it could be a change online. So the little snippet I have here is from an employer who has the payroll service Paylocity. This is what it looks like on their system. It is simply an option that can be turned on. So first things first, make sure your payroll is turned on to allow for that, and then it will be. So a couple of things to note, any matching contributions you may do apply the same way as regular catch-up contributions. If your payroll provider calculates your match for you, it's likely they would apply the same rules to the super catch-up as to regular catch-up. If you calculate your own match, then you will just need to be aware of that. If you are a Nova client, we will automatically amend your plan for super catch-ups, so no action there. We will also update your safe harbor notice, your SPT, and communications. We don't really expect any action to be required with your record keeper. It's really all about turning it on at your payroll provider. So of course, after you've confirmed that, it might, because this is the first year, it might just be a nice friendly reminder to let those employees know between your current employees between the ages of 60 and 63, just let them know that they can elect for super catch-up this year if they don't already know. You'd rather just send them a quick friendly note now because this is the first year, than have them come back later and claim you did not tell them. So that's just a few notes on super catch-up. So moving into to Roth catch-up in general, of course, as Craig shared with us earlier, there could be final regs coming up that could change a few things. But assuming there's no further delay, wanted to highlight a few things that Nova's doing to implement Roth catch-ups. Craig was right earlier. Pretty much 95% of our clients already have Roth and catch-up provisions in the plan. So that really means no action required for amending the plan, changing the plan, anything like that. Nova will take care of those requirements for you. That really is Nova's sort of default, is to go ahead and add Roth. When Roth first came out, 20 years ago, many clients hesitated about adding that because of potential problems the payroll provider could handle it. But in current times, every payroll provider can handle Roth as a separate deduction, and there's really no downside to having that in your plan. So for our small group of plans that do have catch-up contributions but not Roth, again, we will be reaching out to you to recommend you add Roth during the fourth quarter. There will be some paperwork required with the record keeper and payroll provider that Nova will help you with. So watch out for that. Record keepers and payroll providers, they do require a bit of lead time, maybe a little bit more than you or me might think, but we will help meet their deadlines. We're kind of thinking some of our big record keepers who have a large client base that needs to make this change do need a little more lead time. And then for those plans who do not wish to add the Roth feature at all, you will need to remove catch-up contribution from your plan. That will also require paperwork with your record keeper, payroll provider, update notices, everything like that. So again, because this needs to be in effect 1/1 of 26, there is limited time to make decisions, but Nova will be reaching out to you again here soon if you currently do not have the Roth option in your plan. Craig talked a little bit about that deemed notice earlier that we need to supply to employees, and Nova will be providing a sample of that can be used. Just the notice that advises participants that if they err, that any error made for pre-tax contributions when they're only eligible to make Roth, that those elections will then be converted to Roth. So Nova will help you with that year-end notice. Second thing to note, when Nova sends out our census collection in early 2026, there will be a new column. So if you need a little bit of lead time with your payroll provider to build out those reports, just note that when we request 2025 census information, we will be collecting the required FICA earnings on there. Let's see, and lastly, point here, so with next year's testing packages that will be sent out in 2026, we'll start to include a report that will show you which participants are subject to Roth catch-up. This will kind of be done as a courtesy and included in your testing packet. Of course, you can also run the report in your payroll system to identify those people who earned above the limit. Nova is in regular communication with all of our record keeper partners, but each one has a different schedule and doing a slightly different thing. Some of them have not yet finalized their plans to implement this, so we will continue to send record keeper specific communications to our clients as we receive it. For this Roth catch-up, there's no need to amend your plan prior to implementing it unless you currently do not have catch-up contributions. So if you do not have catch-up contributions in your plan, we will be working with you to amend your plan to add catch-ups and Roth if you wish. That's a very extremely small number of our clients, but worth noting that no amendments required to comply with the law change, but unless you don't have catch-up in your plan. Last little tip, again, not everything is finalized yet. It's not 100% clear how record keepers and providers and payroll providers will support Roth catch-up. So we're recommending if you already know do know the affected individuals, that you can go ahead and get an affirmative election for 2026 from them. They would elect on that affirmative election, pre-tax or Roth, up to the 402G limit, the 23,500, and then anything above that they could positively elect to do as a Roth contribution. As we approach year end, it's very important to check with your payroll and record keeper providers just to make sure you understand what they do and don't support. Again, we can't make a broad statement that every payroll provider will do X, Y, and Z. So, some payroll providers and record keepers will thoroughly support it with lots of options, and other payroll providers may have minimal options. So, just something important to keep in mind as we approach the end of the year. So, I did go over a few minutes, but that's my spiel running through that.
Okay, Kim,
Yeah.
I've got to correct something that was pointed out to me. It's not too big a mistake, but that's what I get. No good deed goes unpunished. On slide number 16, when I was talking about super catch-up contributions, this is the first time I've done this session and new PowerPoint. And I tried to be helpful by putting in the other words for 2025. Individuals born in 65 through 68 are eligible. That I went the wrong way, folks. Those are the youngsters. It should have been those born in 62, 63, 64, or 65. Those are the people are the right age, but it's obviously a mistake on its face. The rest of the wording is correct. No good deed goes unpunished. I added that kind of at the last minute, and I didn't check it enough. Mea culpa, mea culpa, mea maxi culpa. Thank you, folks, for attending. I think, Ava, you've got some final words to finish up with.
Yes, thank you, Craig. Just a quick reminder, I know we're a little bit over time. If you do need today's handout, you'll be able to find it next to the question mark icon. If you do have any issues, just shoot me an email at webinars@nova401k.com, and I'll be happy to go ahead and send that directly to you. As soon as I end this, the survey for the CE credit will pop up, and you guys can go ahead and fill that out, and we will be sure to have your CE certificates within a week. Thank you guys so much, and thank you, Craig and Kim, for this presentation, and thanks again for everyone for joining us. We hope you have a great day.
Thanks, everybody.
Thank you.